Today's episode is sponsored by Saxo, the platform bringing you a premium investment experience without the premium price tag. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Is big tech's dominance drawing to a close? Last week we saw a massive shift in markets, with unloved sectors and smaller stocks outperforming mega caps by a record amount.
I want to know if this is the start of something bigger. And in today's dumb question of the week, are small cap funds forced to sell their winners? All right, let's get into it. So it seems like, Roman, ever since we started this podcast, we've repeatedly come back to this same theme, that a handful of US big tech companies are increasingly dominating the market. Everyone's aware of this. They came to be known as the Magnificent Seven. Seemingly an unstoppable rise. But as we know in markets, these things don't last forever. And everybody's been waiting for them to slip up, or at least for the small unloved companies to have a bit of a catch up. And maybe there's some signs that is starting to happen. Or at least there's been a flurry of articles in the last few days about a stock market rotation. Where's all this come from?
Well, I'm not complaining because I've owned an S&P 600 fund, a small cap US fund, for some time, in the hope that it was going to catch up with the mega caps. And so, I was cheering. I was really excited when I saw that it had jumped upwards.
Every day you look at that portfolio, don't you?
Oh, I do. And that's the point, really. It's fun and I can do all the bad things. And that moves my focus away from the important stuff, which is quite boring and really is like watching paint dry. But I think it was exciting to see that. And the reasons behind it were also kind of interesting because it's never that clear, a one-day move, trying to work out why it happened.
I mean, it happened on the same day as the US inflation numbers were released. And they were cooler than everybody expected, as in inflation had fallen more than markets had predicted.
And it is the case that small cap stocks in the US and elsewhere are very rate sensitive. So that kind of made sense. And that's because they've got higher leverage, they've got more debt, which is interest rate sensitive, which is floating rate debt. Often these bank loans are fixed relative to some variable rate index. And they usually depend more heavily on financing anyway, because they're trying to borrow to grow. So there are various reasons why this is a good story for small caps if interest rates are lower.
Yeah, on Thursday last week, when the inflation numbers in the US were released, it was really marked how the market sort of rotated. Everyone uses this term. So what we saw do particularly well were interest rate sensitive sectors like real estate, which had actually been the worst performing sector of 2024, and that had its best day of the year. We also saw home builders do really well. Obviously, they're reliant on people buying houses with mortgages, so if rates are about to fall, that's good for them. Utilities also did really well, and banks. So all the things you might expect to benefit from falling rates, and also sectors which have been unloved over the last couple of years.
And that's a key point, I think, which is the unloved nature of small caps. If you look at the dispersion between small cap valuation and large cap, it's absolutely huge. It's a historic wide. And that usually leads to some kind of convergence at some point. And I'm hoping that it's going to be because S&P 600 rallies.
I mean, can I talk about the Russell 2000, which I know you don't like as an index, but it's like kind of a broad small cap index. You go for the S&P 600, don't you? Because it has a kind of quality filter on there about profitability, whereas the Russell 2000 just waves everyone in. Come in, guys, come in. You lose money, you're welcome here. And that day last week, Thursday the 11th, was arguably the best ever day for US small caps, at least relative to their large cap peers. So the Russell 2000 on that day was up 3.6%. You might say, well, that's kind of unremarkable. It's a big move, but not a huge move. But what was significant was that if you look at the NASDAQ 100, that lost more than 2%. So it was down 2.2%. Now that spread between the Russell 2000 and the NASDAQ was 5.8% for the day. That's the biggest one-day outperformance, I think, on record for the Russell 2000 over the NASDAQ.
So I should have gone for junk. But I guess the other point here is about sustainability. And if it is the case that it's just a junk rally on a one-day basis, that can happen. But the question is which stocks are going to carry on rallying beyond this short-term spike. And I think if you do have an element of quality, it's more likely to be a sustainable increase rather than, one-day wonder.
Go on, keep talking your book. Let's hear it.
So go ahead and buy the S&P 600.
Not a recommendation.
Not a recommendation.
I mean, are we making too big a deal of a one-day outperformance? Because I've got loads of different stats here. Like the Russell 2000 outperformed the Magnificent Seven stocks by around 8% for the day. And it had its fourth best day ever against the Russell 1000, which is the large caps.
Yeah, what gets a lot of attention are these one-day moves, particularly if they're large. But I think the key point here is that if you look at the S&P 500, there was a big rotation in that as well. And there you saw lots of these small cap stocks rallying. Many of the stocks rallied in the S&P 500, in fact, and yet the index as a whole fell by 0.9%.
I'm going to be a real pedant here and say smaller cap stocks, because everything in the S&P 500 is a large cap technically.
Yeah.
But you're right, there was a big rotation within the S&P 500 on that day. So it's interesting that 400 of those 500 stocks went up in price on the day, yet the index fell by almost 1%. And that's the first time since 1996 that the S&P 500 has fallen, despite so many of its constituents rallying.
And I think that's a healthy thing. I think there was too much concentration in the S&P 500 and other indices in the US. So I think, ultimately this is how these concentrations dissipate over time. Sometimes you get big one-day moves where small caps rally more than large caps. And sometimes it's just a kind of gradual attrition as things which have hugely grown, the narrative sort of implodes and they gradually deflate relative to the rest of the index.
One of the clearest indications that there was a big rotation going on was that the equal weighted S&P 500 actually outperformed the market cap version by 2 percentage points on the day, which is the most by a long way since the craziness of 2020.
And it's about time. That thing's been suffering so much. And I speak to a lot of people who think that the Magnificent Seven have just got way out of line with the rest of the index. So they buy that equal cap weighted index. Unfortunately, it has a huge tilt towards smaller cap, large cap US stocks because the cutoff for the S&P 500 is $16 billion, which is a pretty chunky market cap.
Over the long term, there is some evidence that the equal weighted version outperforms a market cap weighted index.
Yeah, small caps are supposed to do well long term. The magic combination historically has been small cap value, where you look at companies which are not just small, but also reasonably priced. Or cheap, you might say. So that's outperformed historically by a huge margin, but not recently.
And by recently, you mean a decade or two?
Yeah, well, as you get older, a decade becomes recent.
Yeah. But I think you're right that a lot of people just feel that the Magnificent Seven have gathered so much capital and been boosted beyond what is reasonable and justified by their fundamentals, even though they're delivering huge profits and are growing those profits rapidly. What the market's pricing in is for that incredible growth to continue. And if you're just a neutral investor in a way and have market cap weighted the world, you're more concentrated in those handful of companies than you probably would have been throughout history. So the allocation to the top 10 stocks in a global market cap weighted index is around 20%, which is the highest in over 50 years.
But really, I think a good way to look at this is what percentage of the profit does this stock constitute? And then what percentage of the index by market cap does it constitute? So do the profits justify the weight in the index? And there are some pretty big discrepancies at the top at the moment, particularly Nvidia, where it makes up about 2.3% of the earnings share, but makes up about just under 5% of the total index.
But its profits are forecast to grow, aren't they? So the market's presumably saying it makes up around 2% of the profits today.
Yep, but it's got to make incredibly strong profits growth year after year. And it's really, what can you get after that? It's just disappointment. If it matches that blistering rate, yeah, it'll keep its position. If it doesn't, I think that could also bring down other stocks which are related to the narrative around Nvidia.
I saw that James Anderson, who was famous for running Scottish Mortgage and picking these big tech growth companies earlier, so he obviously got on the Tesla and the Amazon story early on, he said last week that Nvidia could be worth $50 trillion in a decade. That would be a big gain from the 2 or 3 trillion it's worth today.
Yeah, if you annualize that, it's 26% annual growth per year on average over the next decade, which is possible. I just think that there are so many companies which are going to compete with Nvidia that it's not going to manage that kind of growth. It's definitely going to see other companies encroach on its space, certainly over a decade.
In the medium term, it's so hard to predict. But what we're kind of talking about here with this rotation is the short term, right? And maybe we should just clarify what we mean by rotation. So I kind of see it as there's three different scenarios going on. The first one would be risk off, where investors get scared, they sell their stocks, and they presumably put it into something like cash or bonds, something safe. The second obvious one is risk on. People take their cash and they pile it into the stock market. A rotation is neither of those things. It's saying, I'm going to sell some of my stocks and use that money to buy other stocks.
It can be. I mean, you can get a rotation from fixed income into equity and vice versa as well. So that's the kind of risking, de-risking thing. That would be one type of rotation. Another one would be within the index. So you don't see the overall index move, but within it, you see a sector rotation or you see a style rotation from growth to value. That's the kind of under the surface type of within asset class rotation.
I think that's what we've been seeing. I saw some stats which said that in recent months, equity market volatility has been extremely low, far below where it's been historically. So while the ocean looks calm, underneath the surface, you've got these riptides going on and a massive rotation, but they've sort of just offset each other. And so investors haven't noticed.
Oh, I love these oceanic under the water current metaphors. It's always what we use when we talk about rotations. But yeah, I think that certainly seems to be what's happening here. But really, it's a question of whether it's going to continue, I think. Whether this is just a one-day move or whether it's going to carry on.
Is cooling inflation and I guess then the Fed starting to cut interest rates, is that enough of a catalyst?
I think so. I think this is such a big macro move. It was a massive move to see every central bank around the world tighten, and now we're gradually seeing them loosen, although this synchronization isn't the case anymore. So that itself is going to cause some rotations between countries, I think. So if we look at the US, for example, it's probably not going to be the first out of the gate. Well, we know it isn't this time around. The ECB cut first. Maybe even the Bank of England will cut before the Fed does.
I'm just looking at the FedWatch website now and seeing what the market's pricing in. And they're pretty sure the Fed is going to cut in the September meeting by 25 basis points. So the probability is 91.7% as we record this.
I wouldn't be surprised if the Bank of England also cuts around the same time. So the Bank of England's going to announce its next monetary policy decision on 1st of August, and we'll get a monetary policy report at the same time. So perhaps this time around, the Bank of England's going to go first.
Yeah, the Fed has a meeting the week before, I think, the end of July, but the market's pretty sure it's going to stick rather than twist at that point. It's only giving it a 4 or 5% chance of cutting at the end of July.
Yeah, I think July would be too soon. But I think the key point here is about the synchronization. Everyone raised together, but there's a little bit more dispersion when it comes to cutting. And that'll have an effect on markets, of course it will. So, for example, we've seen sterling rally quite strongly against the dollar, which is interesting. And that has consequences for UK investors because while markets have been doing pretty well in the US, we haven't seen the benefits of that as sterling has been strengthening. If you're a global index investor, you'll be 60% allocated to the US, for example.
I mean, some people will be listening to this saying, well, isn't all this priced in anyway? If the market knows that the Fed's going to cut, why have stocks had this rotation? But I think the point is that because the inflation numbers were cooler than expected, the market upped its expectation for rate cuts from the Fed. It went from something like a 50-50 chance of a September cut at the start of the month to, like we said, a 90% chance now.
Yeah, this is about surprises. And like you say, it was a little bit surprising how much inflation fell. So in May, CPI declined by 0.1%. So that was actually deflation month on month, although looking at 1 month numbers is a bit dodgy anyway. That's the first time that had happened since 2020. And the expectation was a 0.1% rise. So not a huge dispersion there between expectations and reality, but it crossed a boundary from positive to negative, which was a big deal, I guess.
And core inflation came in below expectations as well, which probably means more to the Fed. That's now down to 3.3% year on year. which is still quite a bit above their 2%, but is heading in the right direction.
So the world we're moving into is one of lower interest rates, not very low interest rates like we had previously for a decade, but still one which is better for things like small caps, and it's going to have an effect on currencies as well, depending on who cuts first.
For a long time, people have been looking at the possibility of rate cuts and saying that when that happens, that's going to be great news for stocks, and I guess bonds as well, obviously. But if we just focus on stocks, is there a possibility that this rotation, if it happens, from big tech into smaller companies and unloved sectors, actually causes the overall market to fall a bit, which isn't what people were talking about?
The thing is, so much optimism was already priced in, and the narratives have pumped up valuations to high levels, and that usually means a period of weaker growth. So yeah, I wouldn't be surprised if this dispersion between large caps and small caps resolves itself because the S&P 500 falls more than the S&P 600. So that could be the way it resolves itself. I'd prefer one in which the S&P 600 goes up and the 500 goes down, but hey, we never get what we want.
So is this a kind of buy the rumor, sell the news scenario, do you think? Where we've been waiting for these rate cuts, thinking it's going to be positive for markets, but then when they actually happen, markets go, oh, bit of a damp squib, let's sell off.
But it depends what else happens at the same time. So it's looking now more likely, given what's happened in the news recently, that Trump is going to win the presidency. And if that's the case, there'll be more protectionism, probably. That's certainly his policy that he's declared so far. And that may be bad for markets. I think it's likely to be. And at the same time, if he has tax cuts, there's a problem about the deficit in the United States. So, I think there are all sorts of macroeconomic problems which could start to become more important, even if interest rates start to fall. Today's episode is sponsored by Saxo, the platform bringing you a premium investment experience without the premium price tag. As all good investors know, nobody can control what happens in the markets, but one thing they can control is their costs. That's why Saxo has lowered their prices so you can grow your wealth and more of your money stays right where it belongs, with you. Search Saxo, invest for less.
There's always something, isn't there, that corrects market concentration, where you get to this scenario where a few companies really do dominate the market, and the top 10 stocks now is worth something like 30% of total US market cap. And there was a great research paper recently from Bridgewater Associates called The Life Cycle of Market Champions. And it actually went back through history over the last 120 years and looked at scenarios where we'd had this sort of top 10 doing extremely well and how it tends to resolve itself.
So can I use the word half-life here, Michael?
Yeah, I'll allow it. I think I understand that. It's something like, how long does it take for a nuclear lump of metal or whatever to lose half its potency? Go on, you explain it better than me.
Yeah, exactly. If it has a rate of decay and the half-life is the time it takes for half of the nuclei to decay. So in the case of concentration, it's the time taken for the market cap of those market leaders to fall to half of their value. And in this case, it's around 10 to 20 years. So it does take a long time for this ascendancy to wane, but eventually it does.
In that Bridgewater paper, there's a wonderful graph where it sort of plotted out all the cohorts over 120 years, and it looks at all the top 10. So, the top 10 stocks from 1940, and then the top 10 stocks from 1950, blah, blah, blah. And if you look at the top 10 stocks from this year, 2024, I think it's the line on the graph which has the sharpest run up, as in they've ascended to the top 10 quicker than any in history.
Yeah, so it kind of looks pointy because it tracks the 100 years before that point and the 100 years after. And sometimes you get a gradual build-up and a gradual decay. This time we've got a hugely rapid build-up. So...
yeah, how sharp is the decay going to be? Is there any of the previous examples of market concentration which you think this is most like?
I think the bicycle one, strangely, is quite similar in the sense that it was a new tech that came out of nowhere. Everybody was buying into it. There was a huge proliferation of companies which did it, and then it kind of imploded. I mean, bicycles didn't go away We can still see bicycles on the road, but it's not about dominating market cap any longer. So I think it will become a ubiquitous aspect of our lives, having AI everywhere. But will it dominate profitability and market cap? Probably not. That's my guess.
I think you're probably right. Throughout history, there are things that look quite similar to what's happened now in the market. I mean, for example, railroads once accounted for over a third of the US market, which is roughly where we are now with the big tech companies. And if you look at those railroad monopolies, they happened kind of at the turn of the 20th century, so between the 1900s and the 1930s. And you had massive companies like Union Pacific, who really did own a monopoly, right? There's one railroad and someone's going to own it and it's going to move a lot of goods. But as always with these examples of concentration, they came a cropper eventually. So the way the railroad monopolies seemed to resolve themselves was it had competition from new forms of transportation, largely trucking, but also aeroplanes. And this paper makes the interesting point that regulation was a big reason why the railroads got outcompeted, is that there was stringent regulation placed on these rail companies because they had monopolies, whereas less stringent regulation on the upstart trucking companies. And over time, that eroded their market share.
And the one everyone forgets, which is kind of interesting, are the large chemical conglomerates. And this was in the 1930s to 60s. So these are companies like DuPont and Union Carbide. Because it's so unsexy now to talk about chemical companies. I mean, who cares?
Plastic isn't sexy, is it?
Whereas physics is, I mean, physics will always be sexy.
So was it the kind of plastics revolution that shot these companies to prominence?
I think that it's largely due to things like, certainly according to Bridgewater, it's because the economy shifted towards services and away from manufacturing of goods, certainly in the United States. And then other industries really took up the mantle in the 70s and 80s, particularly telecoms companies.
What was interesting about the concentration in the chemicals companies is it wasn't as big as it was in railroads or tech is now. It only got to around 10% of the market cap. But it seems to be that a lot of these run-ups and examples of high concentration come from new technology, right? That's obviously what we see at the moment. Everyone's excited about AI. And even before AI, these big tech companies had grown based on them getting effective monopolies on different aspects of the internet. But railroads was a new technology and boomed. Plastics, as you said, but we also saw it with automakers. GM, Ford, Chrysler, all grew hugely as the US population began to own cars. And then effectively they got outcompeted, didn't they, by imports from Asia.
And I think that's another lesson there. I think NVIDIA certainly holds the mantle of being the most successful chip manufacturer when it comes to AI at the moment, but ultimately that's going to fade.
And it could be because of competition, or it could be because of regulation. So if you look at telecoms companies, AT&T was the giant. It was a descendant of the Bell Telephone Company, which was actually the first company to introduce telephone lines in the US. And they had this first mover advantage and ran an enormous monopoly until antitrust regulators got involved in the mid-80s and broke it up.
So that's the other way that these huge mega caps, I think, could suffer, which is antitrust regulation. Same thing happened to oil in the 1900s. They were incredibly large. And then gradually what happened is there were lots of breakups and mergers. And essentially, we've now moved back to these mega caps like ExxonMobil. But clearly, this is an industry which is in decline. Even in the US, which is so pro-fossil fuel in many ways compared to other countries, you can see that people realize that this industry will not be around forever. And I think this is just another example of innovation replacing an entire industry.
So it seems like what we're saying is that if you calibrate your expectations based on history and what's happened in examples of market concentration before, we should expect big tech to come a cropper. But that Bridgewater paper does make some counter-arguments about just how well-positioned the Magnificent Seven companies are. So they have extremely strong competitive moats. They are running effective monopolies with massive network effects, huge amounts of proprietary data, and arguably the best computer scientists in the world. Their balance sheets are ridiculously strong, very little debt, and very high margins. And they've also been allowed to go around acquiring lots of small companies, stopping any competitors growing, and integrating new technology into their existing business. So if you're expecting them to disappear overnight, it's not going to happen.
And this is what I always say when people say, look, these companies are hugely overpriced. I always think, well, what's going to be the catalyst in order for them to shrink? And as you say, I think there are many reasons why they'll continue to be dominant for a long time. And I think probably some of it will come down to antitrust laws. Companies like Amazon, which dominate retail so strongly now, and aspects of our life are all dominated by Amazon. So entertainment, you've got Amazon Prime. Anytime you buy something physical, it's often easier to buy it from Amazon because it'll come quickly.
I like Whole Foods though, and I like to pretend it's not Amazon. It's an organic farm shop.
And then they've got their web services. So Amazon touches so many aspects of our life that it's almost impossible to spend a day without giving some profit to Amazon in some form, either directly or indirectly.
Bezos has been selling huge amounts of stock lately, though. Have you seen that?
Interesting.
I think it's because he wants to go to Mars, but that's a good excuse if you want to sell a load of stock, isn't it?
What a place it's going to be. It's going to have Elon Musk. It's going to have Jeff Bezos.
All fighting in a cage.
That sounds pretty good, actually.
And one other point about these big tech companies is that they have been so dominant and grown so much. They could have a rough patch and fall quite a lot in market cap and yet still be the top 10 companies, right?
I think if the profitability of the company starts to fall, that would be the turnaround point. While they continue to generate incredible profits with really high margins, it's difficult to see that turning around. And I think the profit falls will take a lot longer than sentiment falls. Sentiment tends to be very volatile. It comes and goes. Narratives come and go. But profits go on for longer. So we'll just have to see what happens with competition and antitrust. Because the party's most likely to end, I think, because of antitrust rather than some kind of narrative change.
But you're not tempted to go even more into small caps versus large caps because of this high market concentration that we see?
Well, the thing is, I'd really like to buy a quality index. I just love the factor quality because it just makes intuitive sense to me. But if I did, then I'd be even more heavily allocated to these mega cap tech stocks because they score really highly on quality.
Yeah.
So I'm kind of waiting for a general pullback in risk appetite. And then I think I probably will move more into quality as my global equity exposure if I can. I mean, not all platforms support this. Thank God doesn't. But I think I'd like to do that. And I might have to wait until there's a turnaround to do that.
I mean, they are some of the greatest businesses that have ever been built, right? They've been capital light up to this point with ridiculous margins, selling to almost everyone in the world.
Yeah, and they were really lucky. They grew during this period of zero interest rates. They scaled when there was huge amounts of capital available to provide the ability for them to grow so quickly, but they provide good services. So I think that's probably what will give them the greatest longevity. Now, some of the members of PensionCraft do have a tilt, either away from risk or towards small caps. We discuss this on our chat forums. If you'd like to join that conversation to give us your opinion or to discuss it with us, then you can learn more by going to our website, pensioncraft.com/membership.
Okay, today's dumb question of the week is, are small cap funds forced to sell their winners? Because if you think about it and you divide the market up into the large caps, the mid caps and the small caps, if you own a small cap index, it's banded in terms of the size of companies it can buy. And once those companies do well, they outgrow the small cap index, are dropped, and are integrated into the mid caps. So if you're pegging yourself to this small cap index over time, the intuitive question you ask is, well, I'm selling the winners. And I actually came across a related question on the Bogleheads forum, and I just loved the way it was phrased. The poster said, if I'm invested in small cap funds, isn't it like saying I owned Microsoft when they were an infant and I sold them when they were a toddler? I'm going to miss out on, its adolescence and its growth into the biggest company in the world. How do you resolve this tension? Because the data shows that in the long term, small caps have outperformed large caps.
I guess what this misses is the very large growth you get from the point at which indices get the small caps entering and the point at which the small caps become mid caps and exit the index, there's still a huge margin for growth. So for example, if you look at the S&P 600, its market cap bands go from $900 million all the way up to $5.8 billion. So that's a six-fold difference. So that's pretty spectacular growth as you go from a new entrant to exiting. For the mid caps, it's smaller. It's roughly 2.7 times. And of course, for the S&P 500, it's unlimited on the upside. So the key point here is that there's always a kind of conveyor belt of stocks moving up through the index and lifting its value.
So maybe that's the point then, is that there is more room to grow maybe in the small cap index.
Yeah, and the other point, I guess, is that a lot of companies grow very rapidly initially, but then they kind of stall at the mid-cap range. So perhaps you're filtering out those semi-successful stories where they don't quite make it to the big league, but they do go from small, tiny tiddler company to medium size.
Yeah, that's a good point. Is that it's only a few needles, isn't it, that go on to dominate the haystack? Maybe you're getting a lot of sort of good quality straw, even if you're not getting all the needles in that small cap index.
Oh, we're killing this metaphor. But look, I think the other point is that now that interest rates are higher, I think it's going to be more difficult for companies to scale like they did. So maybe it'll be easier to go from tiddler to medium size, but then to blitz scale up to mega cap is going to be very difficult in future.
There's an interesting question, though, about why should small caps outperform the large caps? If you go back to those Farmer and French factors, it's one of the ones I identified. And it did seem to outperform for a long time, though, like so many things in this era of big tech dominance, has underperformed. Do you think it could come back? And why was it there to begin with?
Nobody really knows, I don't think, why small caps have outperformed. I don't think there is a really clear answer to that question. Some people say that the small cap premium has disappeared completely, and it's more to do with liquidity and illiquidity, which generates the excess return. Certainly it's much smaller than it used to be. And so perhaps that has gone away. I mean, there's no reason why there should be an outperformance from small caps. The argument usually is something around, okay, large cap companies, fund managers, people like Warren Buffett, they can't buy small caps. There just isn't enough stock for them to buy a meaningful stake. They'd have to buy thousands of these companies, and it's just too much management. So often the outperformance, the opportunities are overlooked by these large cap companies. They just can't fish in that space. So there are opportunities there which are missed. There's alpha which doesn't get harvested. So as small investors, we can harvest that alpha. That's the usual argument.
And maybe there's just a law of large numbers at play, that when you get to be big, it's harder to grow as fast because there's fewer and fewer people to sell to.
Yeah, I think that is a kind of natural cap for mega caps like Facebook now, which is that so many people already use their product that, who's going to buy the new additional units that you produce? Are they going to carry on forking out for new products from the same company?
But to go back to the question of, are small cap funds forced to sell their winners? The answer is yes, they are forced to sell their winners. That's how it's designed. That's how it's meant to work. But you're constantly refreshing the pool of what the small companies are. And the theory is that they're going to experience faster growth on average than the mid caps and the large caps.
Yeah, I think the biggest worry for me is that we're going to stop seeing so much innovation, and the rate at which new things enter the market and get buoyed up by high profits and growth, that'll slow down. And that's indirectly due to demographic changes. I think if we do get an older population, then the source of that innovation and new ideas will probably be young people who create new things. And I think if that source of innovation starts to dry up, that could affect small caps. So that kind of worries me.
There's also an effect where it takes longer for companies to go public, I think. They're staying private longer, growing bigger as private companies, which we generally can't access as retail investors. And therefore, maybe we miss out on a lot of that growth they would have experienced as a listed small cap. Maybe that's a reason why small cap indices have not done so well in the last couple of decades.
Yeah, listing is a huge pain. I think people don't appreciate this. If you're a listed company, you have to be completely transparent about your books, so you have to publish those reports regularly. There are higher requirements in terms of regulation, in terms of what you can and can't do, and what you can and can't say. And you're completely beholden to your shareholders. So you can't think long term because your shareholders demand immediate returns. So I think there are lots of reasons why a company could choose not to list if they don't have to. And if you can get alternative sources of funding via the shadow banking system or via crowdfunding, then why ever go to financial markets?
Well, yeah, it was the era of cheap capital, wasn't it, over the last 15 years? The rise of private equity. And yeah, I think what you said is true, that companies had the option and a lot of them said, you know what, we can wait a bit longer before we need to go public, even though they were growing fast. So previously, those companies probably would have been in the small cap index to the benefit of retail investors. And also we saw companies being plucked from the small cap index more and more as private equity went in and bought what they thought were the best small caps. So there's this argument made that the average quality of the typical small cap stock has declined over time as the best ones have been sucked out of the index. And maybe that's true. Like, you could make the argument that the Russell 2000 has more unprofitable companies in it now than it ever has in the past. I think around a third of Russell 2000 companies do not make a profit.
Yeah, so slower innovation, things which are successful being plucked out and taken private, and a greater reluctance to list in the first place. I think all of that contributes to poorer returns for small caps in the future.
Because maybe the issue is not so much that small cap funds have been forced to sell their winners as they graduate to being mid cap. Maybe the issue is that they've been forced to sell what would have become the winners before they became the winners. I mean, just to wrap up here, I want to ask you, Romin, in your fund portfolio, you have tilted towards US small caps. You bought the S&P 600. Why did you do that? Are you still confident in that tilt? And what would cause you to sell it?
Well, I was talking to a client and we just looked at the market cap numbers on Yardeni, and we looked at the valuations, in fact, for the 400, 500 and 600. And I just noticed the huge valuation dispersion between the two. And I thought, okay, that could be in my fund portfolio. So I did buy it. It isn't a big allocation, I have to say. I've also gone for UK small caps, but I also combined it with other factors like quality, value and momentum. And I haven't sold it, but it's taken a very long time for any kind of pickup. So it was exciting that it did happen, and I am hoping it's going to continue to outperform. But look, this is why I have a small market cap weighting for fun, right? Because it doesn't usually work. But would I have a huge tilt to small cap right now? Would I buy an equal weighted index for the US instead of the market cap weighted index? No, I don't think I'd take that kind of bet.
Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.